leveraged loans. My name is Gary Simmons, and I lead AFME's high yield and ECM divisions. And in acknowledgement of the interaction between the European high yield and loan markets, leveraged loans have become an increasing focus for AFME's high yield division. And we have also been very involved in work related to non-performing loans, responding to and engaging with both ECOFIN and the European Commission on their NPL action plans, and forming an AFME NPL working group to monitor and respond to relevant NPL developments. As you may know, as recently as 2014, the level of NPLs on European banks' balance sheets reached over €1 trillion. While through regulatory, governmental, market, and other actions, this number has fallen significantly to around €494 billion as of September 2020. The ECB has estimated that in a severe but plausible COVID-19 scenario, that number could rise again to as much as €1.4 trillion. Therefore, it's important to look at every aspect of this issue, including the information and data that is necessary and available. We believe that in addition to substantive regulatory, legal, and market rules and practices, accurate, consistent, and adequately available information and data about loans is essential to market transparency and would potentially make it less likely that we again see the extremely high volumes of NPLs that we've seen in the past. Today, our panel discussion will analyze the EBA's loan monitoring guidelines and discuss which parties are most impacted, and we'll also look at covenant trends and some of the impacts of COVID-19. You will also have an opportunity to engage in Q&A with the panelists through the Q&A box. Thanks again for joining us, and I will now pass it on to our moderator, Ben Kovachka of Reorg, who will introduce the panelists and start the program. On to you, Ben.
Thank you very much, Gary, and glad to be here. So I would like to first hand over to the panelists to introduce themselves, starting with Simone.
Thanks, Ben. Hi, everyone. My name is Simone Bonenberger. I'm VP of Product at EigenTech. We are a no-code document AI platform which allows users to automate the analysis and review of their documentation. In today's panel, I can talk about the efforts to digitize the end-to-end loan lifecycle, which we're supporting for various European banks, be key milestones such as loan negotiations, onboarding, monitoring, servicing, or offboarding. And thanks so much.
Thank you very much, Simone. Ed?
Yeah, I'm Ed Eierman, and I head Fitch Ratings European Leverage Finance and High Yield practice, analyzing portfolio credits and market developments.
Thank you very much. And finally, over to you, Rick.
I'm Rick Watson. I run AFME's Capital Markets Events and Membership team. And as a result of that, I work actively with our Prudential division, whose members are actively involved with the ECB and the EBA with regarding to all matters prudential, including monitoring and reporting issues on leveraged loans and other asset classes, but also Gary's high yield division.
Thank you very much, everyone. So the primary topic we are here today to discuss are the new EBA loan monitoring guidelines. And I think it would be best if we first kind of begin with a quick background and the key points of the guidelines. So maybe, Ed, if you take this first question, and then we'll pick it up from there.
Actually, I would defer to Simone on the specifics, but obviously the European Banking Authority is a super regulatory body that coordinates the implementation and monitoring of policy set down by the European Union and the European Parliament and other EU bodies. And obviously the risk monitoring function is part and parcel to their ability to monitor the health of the banking system. And we are certainly familiar with how the EBA looks at the issue of corporate credit risk in particular. And I think it's important to emphasize that their focus is on the technical side whereas there are other regulatory bodies like the European Central Bank, which implements policies like leverage lending guidelines, which can be complementary to what the EBA is doing. But I'll let Simone comment specifically on the EBA.
Cool. So the EBA guidelines for loan origination and monitoring will come effect in the middle of this year. And really the purpose is for banks to strengthen their origination, but also live monitoring processes on the portfolio level in order to mitigate or decrease the probability of a loan to turn into a non-performing loan. And what that means is that in the middle of this year, banks will have to demonstrate that for newly originated loans, they have stronger governance and data collection processes in place. Next year, next summer, that will be extended to renegotiated loans, and then 2 years following from there, it has to be the entire back book. So really, it's a very data and governance focused initiative to help drive banks to better understand the actual credit facilities they've underwritten, as well as how they're performing over time.
Rick, would it be possible to maybe get a bit more of a background on all of the stakeholders involved in kind of shaping these guidelines, the consultation process, and what the timelines look like?
Sure. Thank you, Ben. I mean, from AFME's perspective, we have two different hats in terms of leverage loan origination. Through our high yield and leverage finance division, which has an arranger who has members who are arrangers of transactions, they're primarily in the business speaking to any type of originator of leverage loans. These could be banks. They also could be non-bank financial institutions. And our members in that division as intermediaries sell to whichever types of investors make sense. Some of them could be regulated institutions such as banks, but they also actively sell to CLO structuring vehicles, which then tranche the securities, and those securities are then distributed to various types of insurance companies, pension funds, as well as banks. In that role, our members have a perspective of the importance of disclosure and reporting and data quality, more so than whether the investment itself is characterized as being safe or prudent. That really isn't the job of our arranger members. Our members in that sense are focused on making sure the information's in the hands of the investors who will make those judgments. The investors who buy those securities are suitable for those types of instruments, but it's not the judgment about whether those securities are risky or not. Some of them will be, some of them probably won't be, and the rest are somewhere in the middle. On the other hand, our Prudential division is very much focused through its members. And generally, our Prudential members would have the head of Prudential regulation within the large banks. They'll have many types of risk management reporting functions. They will be responsible for supervisor relationships, compliance in terms of prudential issues, as well as capital charges and liquidity measures regarding Prudential. That group has a different type of focus because their members are concerned in terms of leverage loans. What is compliance with loans originated, retained by the banking system, and in turn those which can be sold on? And if you step back and look at the big picture, those are two very different perspectives, which we do feel should and do coincide. Because if you're in, for example, in a role of an originator, your main job is to make sure that the investors who buy these instruments, which effectively can go all the way from CLO equity investors who are looking for higher yields, higher returns, and they're going into types of funds which are designed for investors suitable for that, to, on the other hand, much lower risk type of investors who buy only the AAA tranches of CLOs or underlying leverage finance. It is, on the other hand, are in the shoes of the ECB or the European Banking Authority. The job is to look at the financial system as a whole, because I think the last thing any one of us would want to envision is banks be viewed as a different type of a capital market fund. They're not, and they never will be, and they shouldn't be. So I think it's important to step back and look at those two very different perspectives, because the participants in both those sectors have different goals and different scope.
Thanks, Rick. And kind of maybe looking a bit closer at the impact of these new loan monitoring guidelines and any additional kind of requirements that will be required. And I know, Simone, that you at Eigen provide solutions to help with digitization and ability to monitor more effectively. Like, what do you see? Where do you see the future within the banking system headed in this direction?
Yeah, thanks, Spencer. I think the EBA guidelines came at a very interesting moment in time, right? So if we specifically focus on leveraged loans, and the guidelines go beyond leveraged loans, they focus on all credit facilities, but leveraged loans are very interesting for obvious reasons. We're thinking about when the guideline is actually beginning to take effect. It's coming from in a very interesting market context, right? So we obviously had to go through a quite tumultuous market last year that also affected leveraged loans. Leveraged loans in Europe have gone into the market with a lot that's widely publicized COV-lite provisions, right? I think 80 to 90% of European leveraged loans were COV-lite going into the market. There was an absolute fear of bankruptcies and what the impact would look like, all the way like trickling through to CLO investors and wondering if their over-collateralization buckets would get triggered, etc. So I find that is a very interesting market context. What the impact of the EBA will look like, I think, is hard to predict. But at a first step, what it will clearly do, it will accelerate the digitization of the entire loan operations program in banks, which currently is extremely siloed, extremely manual process. I think most bigger European banks have up to 70, 80 people just dealing with keying data from loans into systems. The immediate impact will be that banks have a much better real life understanding of the credit facilities in their portfolios. So in a market context like COVID, that really will play out if the name of the game is to be able to react quite quickly and understand which loans, for example, to prioritize, to strategically renegotiate, for example, to avoid any covenant breaches. So I think from that point of view, I think the EBA will accelerate digitization across banks, but it also will give banks a better view of their portfolios in real time. And that's really key. Name of the game is quick decision making.
I think the points that you touched on with regards to prioritization and kind of understanding where the risks and the risk silos lie, it's a very interesting point, and I think we can touch on it in a minute. I just quickly, before we start going down the rabbit hole, I think Ed had a very interesting perspective on the EBA loan monitoring guidelines, and also in the context of what's the historic kind of leverage lending regulatory environment look like, and I think it's very interesting kind of context to start working from. Ed, if you could kind of give some color on that.
Well, I tend to look at what the EBA is doing as just being a perfectly rational expectation that any kind of policymaker would want its public market institutions to hold, which is that we need to know what risks you're assuming if we regulate you. And likewise, there are other stakeholders that want to make sure that bank managements are fully committed to understanding and reporting the risk that they assume. I think it's a bit different when we have things like the leverage lending guidelines, which are different. That was an initiative that first developed in the United States as the global financial crisis was ending, and we had the phenomenon of quantitative easing and the return of capital searching for yield, and the financial sponsor community and leverage borrowers in the U.S. returning to pre-global financial crisis leverage levels. There was some concern that, maybe the regulatory and risk build up process, and they took it upon themselves in leverage credit, in particular in the U.S., to say have an amortizing debt profile. And those were characteristics that the market seemed to have as constraints back in say, the previous default cycle, which was the telecom default cycle of 2001, 2002. We rarely saw new transactions come with more than 5 times leverage. We rarely saw transactions that had bullet-only structures, and we rarely saw covenant-light-only structures. So, especially in loans, the U.S. leverage lending guidelines were introduced as what they called the tripartite regulator, which was the FDIC, the Federal Deposit Insurance Corporation, the Officer of the Control of the Currency, and then the Federal Reserve. So 3 regulators basically announced these guidelines on leverage limits and amortization profiles for arrangers in 2013. And at first, the market didn't seem to abide very much. And it wasn't until the fines started coming down from the regulator on the banks that were breaching these guidelines that we started seeing the leverage levels in the US peak at 6 times. But we also saw the definition of EBITDA change. We also saw banks not captured by the regulation taking market share. And I think that's what informed the ECB in 2016 when it announced it was looking at implementing similar leverage guidelines in Europe. And it was the ECB. It did not include the Bank of England. It did not include other banks that were not part of the Euro system. So, and the idea behind the European leverage lending guidelines, I think, as they were implemented, was that it was predominantly a recognition that monitoring and enforcing specific guidelines on leverage might be very difficult. But what it did do is require the bank managements to report their exposures over 6 times. And so I think that's consistent with the spirit of the EBA, which is that we need to have a system where we know that the managements are aware of the risk they're taking. And again, I think that the question over whether or not we can regulate risks, and to a degree, there is some level of regulation. CLOs, as Rick mentioned, are rated, and our business here at Fitch is about our application of relative measures of risk, which are ratings, and there are limits in terms of CCC exposures, and not just on CLOs, but also in loan funds and in bond funds. But by trying to impose a standard of riskiness in a leverage level or in a capital profile, I think we found that the market's going to find ways of gaming that. And so the emphasis on monitoring and disclosure, I think, is very interesting. Now, I would also say that there are issues with that we have seen. We have seen, for example, public to private transactions where companies are going from being listed to unlisted, and the execution issues around that. A lot of managements and sponsors can say that reporting and disclosure is a bit of a distraction. Likewise, corporate carve-outs. You're taking a division of a large company and putting it in separate ownership hands for the first time, and so there are a lot of separation and other issues that require the management's time. And so they put in delays in their initial reporting. Sometimes it's up to a year or even 18 months before they have to report their financial performance under their covenants. And then lastly, I would just say that the emphasis on covenants isn't just about cov light. It's also those restrictive covenants. So a bond is essentially cov light in the sense that it's the incurrence of additional debt, whereas a loan typically had financial maintenance covenants. And again, we wouldn't rate a floating rate note any differently than we would rate a floating rate loan if they were both covenant light. It's the restrictive covenants that I think have changed things. And the sort of bargaining power that has existed for issuers over the last several years has just meant that more and more has gone into the dilution of restrictive covenants. And I think there, it's not just the banks, it's also anyone that's buying in these syndications. You know, they have very little time. The arrangers are under intense competition, the sponsors are under intense competition, and the ability to kind of have awareness of what's going on, you know, I think it is a concern broader than just the banks. But it's good to see that the EBA is you know, trying to make it an aspect of accountability.
I think that's also super interesting, but particularly I think the point that you mentioned on documentation and the documentation kind of becoming looser across the spectrum is a very interesting one, especially in the context of COVID. I mean, one would expect that last year as COVID hit, and there was a lot of uncertainty regarding liquidity, regarding performance, when are things going to come back to normal, forecasting the future. Just general uncertainty about earnings going forward. You'd expect that documentation would reflect that, and you know, it would tighten. And I think we've seen some examples of this, but at least from what I've seen, I don't think I've necessarily seen the kind of tightening that one would expect initially. I mean, is this the kind of picture that you're all seeing as well, and kind of what's your thoughts on this?
Well, we see a debate about the sort of benefits of covenant light versus the concern over it, and I think there's enough evidence on both sides that debate will keep going. So on the one hand, what COVID did was interrupt businesses, and I think that a lot of, you know, this idea that there aren't covenants isn't really true, because we have spring covenants and revolving credit facilities, and that's the exposure that the banks have. I think as Rick alluded to, a lot of them are originating to distribute, but they are keeping exposure in the form of revolving credit facilities, and they do put covenants, springing covenant, financial maintenance covenant. Of course, when the pandemic broke in March, a lot of companies just went and drew on their RCFs, even though they knew full well they were going to be in breach in the next reporting period, but they wanted to get access to the liquidity while they could. And then when they did breach covenants in the following quarter, most banks recognized it for what it was, which was a temporary interruption, and that you know, the financial market was going to hold. The central banks and the ECB had done its pandemic relief program, and we saw the secondary market tighten. And then, of course, as the lockdowns ended, we started seeing business conditions recover pretty quickly. And so, yes, leverage rose, EBITDA went down, and drawings on RCFs went up. We saw even new money situations. You know, again, the permitted indebtedness under those covenants allowed additional drawings or to extend term loan Bs. We saw super senior debt come in on top. And again, default rates have been pretty, you know, I think pretty low. You know, maybe we're still sub % total 12-month default rates on European leverage loans. And so this idea that we can trade through the cycle because we have these loose covenants and because we have ability to raise money quickly in an unencumbered fashion is supporting a lot of credits. On the other hand, we have also seen businesses not recover, and their losses have been greater. And as the primary market has kind of returned to pre-pandemic risk tolerance levels, that's also true in new covenants that are coming in new transactions. And so I think that this debate that covenant light works certainly has evidence, but it's also true that there's evidence in a number of fashion retailers and in some of the more severely interrupted sectors that that you can be subordinated. You can see your collateral move out of the restricted group, and you can be restricted from transferring your assets at an effective secondary market price. And all of those things are supposed to be premises of leverage loans as an asset class, and so to some extent that's clearly also compromised.
I think just to build on Ned's point, I think there was a change in documentation in the first half of last year, sort of in the immediate, I think, peak of the crisis. So EBITDA add backs. We saw much more that revenue losses from COVID could be added back. I think in leveraged or broadly syndicated loans, the leverage ratios briefly dropped until they went up again to about 6 at the end of last year. So I think there are a couple of elements in documentation that has changed in general. What I find very interesting in this borrower lender dynamic is obviously then the aggressive exploitation of some loopholes. And we may have had that without COVID, but what I always find very interesting is talk about the US examples of getting prime, be Trimark or Boardwriter or Certa Simmons. And the question I have is obviously, will this happen in Europe as well? But that's a clear example of underlying documentation or dynamics that have been exploited and that may have some repercussions in the market.
Yeah, I think just from our high yield membership perspective, another thing to keep in mind is that if you look and step back at the dynamics of the CLO market, the data is so essential to that market. I think I've seen one recent rating agency report that says there are 53 active CLO managers, and there is a vested interest of those groups to not blow up the equity investors who basically, end of the day, make all these CLO transactions happen. And the assumptions that the CLO equity buyer make in terms of probability of default and loss given default are no different conceptually than the way a bank lender would look at things. The main difference, of course, is because the CLO equity investor is investing in the bottom part of the structure, the leverage and volatility will be, by definition, a lot higher. And I think if I were a banking regulator, I would say that's all fine, but it probably doesn't belong in the banking system. So I think one of these things that the guidelines has certainly prompted, I think, is a very healthy debate. It's not just as the importance of high quality documentation and processes, as well as reporting and monitoring, but it's also identification of what are sustainable business practices in both the bank and the non-bank market that will basically keep the investors, particularly in the CLO market, who are in many cases investors focused on long-term instruments. Sometimes they're complex, sometimes they are not. But it's from a European perspective, and this touches upon COVID. COVID's performance statistics right now on leveraged finance as well as all loans are probably being artificially propped up by government loan guarantee programs, which all start to run out in the first 6 months of this year. We just recently issued a report on this looming, I wouldn't call the word crisis, but the looming reality is that as these government support measures run out over the next few months, in Europe is roughly €1 trillion hole of equity that has left European corporate balance sheets that will need to be replaced with other types of equity in order for the corporates in 2 or 3 years not to be severely wounded by having unsustainably high leverage. So we do think it's a healthy debate going right now with the supervisory authorities about which types of particular assets sit and stay within the banking system and which ones go outside of the banking system. But we at AFME feel very strongly that it's important that both of those sectors succeed and lay the groundwork for ongoing sustainability.
I think that's a very interesting point, and I have a follow-up question on that. So, kind of in the line of documentation and documents, as well as there basically being a hole in kind of equity that needs to be replenished in the system, would you say, and I also have an opinion on this, but would you say that we yet have to see kind of how the Cov Light or kind of the loosened documentation performs through kind of the full cycle? And open to anyone.
Okay, well, I'll take the first tab. So I think that if we're looking at the leveraged loan market, we're looking in the wrong place, because honestly, we do not see financial sponsor-owned companies, outside of the most severely impacted sectors, accessing those government guarantee schemes. And the European leveraged loan market is somewhere in the 300 to 400 billion market, broadly syndicated, depending on who you ask. And And maybe there's another 50 to 100 billion in kind of what we call the private world of unitranche and maybe smaller but unsyndicated. And again, outside of the businesses that have been forced to close because of distancing and travel restrictions, we don't really see companies accessing those guaranteed loans. And I agree that they're out there, but I think the space, I think this is the big question mark that we have. From an analytical standpoint, we're trying to determine to what extent a credit that we feel is going to recover from the leverage interruption of COVID, the lost EBITDA and the additional drawings, there's going to be a post-lockdown recovery that's going to be quite substantial. And so revenues are going to come back, operations are going to restart, and cash flows are going to be redriven. And the question is, to what extent do they go back to their pre-pandemic operating profit growth and margin profiles? And I think the big question is really around suppliers and customers that might be impacted by the removal of a lot of these schemes. And so that's very difficult to tell. But our view is that the financial sponsors have been very selective in what they've been willing to pay very high multiples on for the last several years. And those tend to be European champion and incumbent companies that are high cash generative, high barrier to entry companies that, of course, they benefit from low interest rates, and they also want these restrictive these covenant standards so that they can pursue their buy and build strategies to have more scale, more efficiency, and more cost savings. And all of that, I think, has largely come into play. So I think Rick is absolutely right that there's this hanging question over what happens economically when these schemes are gone. But I'm not sure that it's going to be directly on leverage credits. I think it's going to be more indirect in the SME and other sectors of the economy, which of course the banks are heavily exposed to. But I don't know if it's a covenant issue in leverage credit.
So I think to Ed's point, what's interesting is that I think documentation has adjusted to that point, and I can only speak for CLOs here right now. But for example, in CLO offering memoranda in Europe, we have a lot more provisions that allow the CLOs to actually participate in workouts. And I think clearly they popped up in the anticipation that might come into play this year a lot more. So I think for anything newly issued, the language is probably already anticipating a market where we need more flexibility for the long term.
Yeah, one last point on the SME side of things, and I completely agree with Ed's earlier comment. It's important to look to see whether the leverage finance origination model is focused on people and companies who will be most impacted by COVID. I mean, one of the things we concluded from this report we just issued about a month ago is that the largest corporates can already access the capital markets really well. The companies that are going to struggle are certain I'd call them mid-cap unlisted corporates and in the SME sector. And the challenge you have, and one of the things we recommended in this report, was that there are SMEs who probably need 2, 3, 4 years of time to get themselves through COVID. And are those, I'm raising the question, of the sectors most impacted by COVID, which of course would be the airlines, retail, hospitality, transportation, those types of issues, are most of those types of companies in the leverage finance market? Yes and no. Some are, some aren't. So I do think it's really important to look at sector-specific implications on COVID.
I agree, and again, I think that we've had the last year the market to sift through, and you can see without question that a lot of services sector, especially information technologies, telecoms, healthcare services, there's been no crisis. Those companies had no impact on the revenue. If anything, the pandemic accelerated the trends in their favor. And then you've had some credits that were just cyclical in nature. And again, those I think we're able to forecast and see through that. And then the credits that were severely impacted, they've gone into hibernation. They do have very flexible cost bases. We've seen the furlough schemes support them. We've seen the rental relief schemes support them. They just needed liquidity to pay their coupons and their management teams and a minimum capex requirement before they can reopen. And there is, some, I think, open question as to whether they'll be able to return to their pre-pandemic profile in full, but some degree of recovery is certainly priced in the secondary market. We're trying to put those into our ratings. But we do not have that many what we would call price takers. Most of our leverage credits that are in the broadly syndicated market, that are in CLOs, where the banks have got big exposures to RCFs. These are the companies that are able to defer their payments rather than rely on help to get paid. But I think it's the customer end and the broader economy that's going to be the real question. And we don't really see that until the end. We think that there's going to be plenty of economic support in 2021 and into 2022. But I think it's absolutely a concern, especially in Europe, that we're going to have the end of these support schemes become a problem. I'm just not sure that in terms of credit exposures on bank balance sheets, it's going to come from leverage credit. That's going to be the areas of stress.
The question is also how independent are these sectors really, right? So I think, Rick, you called out SMEs, which probably suffer the most and are supported through furlough schemes in the UK, but they're one of the biggest employers. And so if we go through a scenario where unemployment rises, at some point that will trickle through to leveraged loans as well, right? Large institutions that were considered safe, but their revenue or EBITDA will go down.
I agree. In terms of scope, one other thing I just could add to build on Ed and John's comments. In an article the ECB came out with last year, they were noting of the 26 largest institutions that fall into their supervisory remit, there's about 400 billion euros of leveraged finance, of which is about 20% of the overall 2 trillion euro corporate loan book. And of those 400 billion leveraged finance loans, I think slightly over half were of like type of documentation. One of the things, if I were getting back to which sector the risk sits in, if I were sitting as a banking supervisor, my job is to make sure that the banks are stable, that they have the right robust systems, that they're very viable for the long term, they're there to provide not only services to the public sector, but also to the shareholders and other constituents on a safe and sound basis. So if I'm a banking supervisor, I probably do care about loss given default rates and probabilities of default. And I think there is data that does show that there is a slightly lower recovery rate, I believe. Ed, look to you, from Cub-Lite instruments than non-Cub-Lite instruments. Not catastrophically lower, but it's a bit lower. But unlike a fund, a non-banking sector type fund who can price an instrument to get a certain yield, if they don't like the price to yield, say, for example, if you're a CLO equity investor and you're looking for a yield, long-term yield and internal rate of return of roughly 12%, some number, 10%, 14%, whatever the figure is, you can do a number of different scenarios of loss given defaults and recovery rates to get to that figure. If you're a bank lender, you can't do that. The loan either defaults and then you're basically in a recovery mode, or you don't. So effectively, as a banking supervisor, you probably want to have some kind of floor on the overall credit quality across a bank's range of books in terms of risk profile. If you look at the capital charges banks incur for holding equity investments, it's pretty high. And a lot of our Prudential members keep noting this over time. And my guess is if you ask a banking supervisor, that is deliberate. They really do not want banks to turn into equity investment vehicles. They're broadly there to provide loans as well as capital market services. So getting back to the important distinction, There are different sectors that hold different types of risk and originate different types of risks. But I do think there's an important halo effect from safer and sounder and better disclosure and reporting across both sectors.
Yeah, just on the loss given default thing, the variable that drives loss rates is the sector more than the documentation standard or the leverage levels. So it's, print publishing. There was a time, 20 years ago when we all loved we all loved Yellow Pages companies and we hated cable companies. And 10 years later, that's the complete reverse. Fashion retail, it's obviously something that the loan market stopped financing, several years ago, and we started seeing the bond market come in and replace that. The issue with recovery or loss given default, in our view, is really a function of the rise in senior leverage that we've observed, and that's why we expect recoveries to be lower. The evidence from the last 12 months, really isn't great, because most of the things that we characterize as defaults, a lot of other constituents would characterize as amend and extend exercises. And we are kind of, again, papering over, if you will, in some cases, the real issues. And in other cases, they just needed the amend and extend to ride out a very severe but short-term storm. And so I think it's going to be several years yet, and probably a rising rate cycle when leverage multiples today on coupons that can't be refinanced in 5 or 10 years, that we start seeing the impact of the documentation standards across sectors. So I think it's we would all love to draw conclusions about Cov Light and documentation, but again, when one of the things that the sponsors were upset about when the U.S. leverage lending guidelines came into play was that 6 times for a software company is not that much leverage when your free cash flow margins are 15%. 6 times for a cyclical auto supplier is way too much leverage when your free cash flow margins are 2% and quite vulnerable every 3 or 4 years because of the CapEx investment cycle. So it's quite arbitrary to be putting in these types of things. And I agree with Rick about that the banks have got a concern over risk, and the regulators should have something like that. But I think that we have to kind of take the sector into question, and each credit on its own merits before we start doing arbitrary blanket risk measures, other than, of course, our ratings, which we'd be happy to provide.
That's an interesting point. If we take away the type of risk that a bank underwrites, if you think about the LGD variable and how it drives RWA, I think better digitization and visibility of underlying data. And I think for LGD, you need to prove your assumptions have to build around 5 to 7 years, so one full economic cycle. I think this whole EBA guideline will lead to much better data quality for credit facilities, and also probably bring down LGD numbers or variables for banks, just as one of the benefits, even independent of how risky it is what you've underwritten.
And at kind of following up on what you were mentioning with regards to kind of increase in kind of senior / priming leverage. So we have seen a lot of kind of leverage come in through COVID, and a lot of that was priming in some way, shape, or form. So kind of going forward, are there any kind of permanent changes that you expect that we have kind of seen happen, or are there any other changes? So, for example, in the bond market, we have secured or super senior RCFs, and then we have the rest of the structure. Do we expect structures like that to kind of follow on, for example, in the leverage loan market, where sometimes the RCFs are pari with the loans? Are there any kind of more forward-looking trends that you have in mind to look out for?
I haven't seen anything. If that's what you're asking, I haven't seen any proposals. I do think that the bank market has supported the direct lending market, if you will, the kind of the private debt community, which typically does smaller deals, although they would argue that they do big deals as well. And they found that they needed revolving credit facilities, the working capital swings and other things. When we first started looking at private debt deals in 2013, 2014, sometimes they were coming to us without any participation by the bank. They were indeed originated by the private debt houses, but they needed revolving credit facilities. And of course, the banks were saying, well, actually, we're not really comfortable lending to a 10 or 15 million EBITDA company at 6 times leverage. And so we will take exposure, but it has to be super senior. And you started seeing this relationship between the banks and the unitranche providers or the direct lenders, where there was a super senior tranche. And of course, we see that with floating rate notes, I think for different reasons. But so it's again, I think on the broadly syndicated deals, you see the banks are originating to distribute, and their exposure is in the RCFs. I think on regional leverage transactions, so Spanish banks supporting Spanish sponsors on Spanish companies, there they are probably taking buy and hold positions. But what we see there is that the leverage isn't as high. They're amortizing structures. They're but much lower risk profile than what we see in the broadly syndicated market or even the private debt market. So I think, again, each case has to be taken, but I do think that if there's a real concern, then maybe we start seeing something like super senior revolving credit facilities on term loan Bs, but they are the same facility. And again, I think it's a real question as to how do you regulate it, because 6 times leverage applied to an IT software company isn't the same thing as it's applied to a cyclical auto supplier. So it's possible that we could see some initiatives, but right now I think the evidence is kind of in favor of all the flexibility that these issuers have bargained for has helped mitigate the risks from the worst recession in terms of its steepness and its severity. It was short, and one reason it was short was because there was adequate liquidity and capital buffers in the banking system, and also because the banks did not accelerate when and enforce when covenants were breached. They realized that those covenants were there to protect from broken business models, not from some interruption from something external like a pandemic. And so they could see through the crisis. And I think we're still there, but I agree completely with Rick that there are other things that are going to happen once the pandemic ends and a lot of these support schemes are taken away. And we're going to end up with a lot of companies that are going to have legacy leverage, and they may be zombified in some way. And there, it's quite possible that we could be looking at materially lower recovery rates, and that will then show up in the data. I just don't think it'll show up for some time.
And with regards to, so we touched earlier in the discussion on some of the examples in the US where we've seen collateral being moved away. Taking example of J. Crew way back when, but we've seen a lot of these recently. We haven't really seen this in the European market. And couple of questions on this. Why do you think this is the case? Should we be concerned regarding some of these kinds of transactions being exported here? From what I remember, I think we've so far only seen Olympic entertainment in the bond market. If my memory serves me right.
Yeah, no, there are instances. McLaren, certainly Travelport in the loan market, they did it. And again, these were all bargained for. It's not something we should be surprised by. And again, I think that the idea is that there's a case to be made that these actions are about preserving long-term enterprise value. And again, there are some situations where it works, and in other situations it may not. Again, we've seen how much debt was on New Look when it was first bought out 5-6 years ago, and how much debt is left. It's a lot lower. the yellow pages, so local, the French directories business that tried to become a digital media company still is. Again, multiple defaults over years and years and years. But these things were a function of their sector and their business model and the disruption. And that's probably what covenants and security packages should protect you against. I think the broader issue really is one of labeling. Is it really senior secured if your collateral can be moved? Is it really, senior secured if you can, new debt can come in above you and you become subordinated? And if you're a CLO, can you really manage your risk by selling assets when you think that the credit story isn't what you signed up for and you want to remove it? Maybe you can sell it, but at a bid ask that forces you to hold it longer in the hope that things get better. I think those are the kind of the longer term issues that we're facing.
And in terms of kind of tying this back to the EBA guidelines and what we have in the leverage kind of leverage lending space, how would you kind of quantify the impact of the guidelines on issues like this? Do you expect there to be a bit more information available to the stakeholders to assess the risks going forward?
I think. Yeah, I think thanks, but that's a really good question, because I think in the end, if you think very optimistically, I think better data should ultimately lead to better liquidity in the market, right? And so, for example, non-performing loans in Europe, one of the biggest issues of moving them or selling an non-performing loans portfolio is that it's just so expensive to do the right due diligence because data tapes from banks are often very poor, right? So I think better data quality all around can only help that, right? More transactions, not so much value leakage when you try to sell these NPLs, but that's what I would hope for. I think that should be the ultimate benefit.
I think from our Prudential members' perspective, because we've discussed this a lot with our members over the years about what's the right balance to strike between a common single supervisory approach in terms of which resulted in the guidelines of the EBA, or rather a bespoke type of arrangement which you had 10 years ago in the system. And the thing our members rightly keep flagging is that you've got lots of different banks all over Europe who have existing systems, and particularly the different sizes. I think it was mentioned before that one firm had 70 or 80 people collecting data for their loan origination systems, whereas you have smaller lenders will probably not have any of that data, but probably do have other potential mitigants. Now, I think the question that Simone rightly raised is how much more data does any bank really need to provide to their supervisor to convince them that the problems it experienced with the NPL crisis over the last few years really can be mitigated? I think that's really the question which all these regulatory policy issues are probably rightly trying to address. And I think our members who really just continue to ask authorities to take a pragmatic approach. What's workable? One size doesn't necessarily fit all situations. It does come down to individual supervisory arrangements with bank supervisors to come to a comfortable arrangement to make sure that those risks are understood, managed, and controlled, and there's a proper, particularly governance procedures in place. We haven't spent a lot of time on that, but it's a really important issue going forward across a number of different areas. One of the issues that, Ben, you brought up is the sustainable finance area, which clearly is an issue, not only leveraged finance, but for all different types of lending. And there was a major consultation just completed a couple of weeks ago that our sustainable finance member group commented on about how essential it is to really firm up governance, which really across not only just financial institutions, but also the corporates that produce the data that will be necessary for the banks to report on sustainable finance. But it is so essential that the governance be in place so that loans which do have higher risk profiles are carefully looked at by management and can be basically defended in front of the supervisor.
Thanks, Rick. Kind of one of the last questions that I wanted to ask, because it's been a big topic in the bond market that I follow, is ESG, and I guess the governance side that you just brought up, Rick, but also in terms of kind of the environmental and social, and this is also part of the scope of the EBA monitoring guidelines, although maybe not front and center. So I'm just curious if what's the opinion of US panelists on these issues, and what are kind of in a nutshell, what should we expect going forward? Ed or Simone, would like to jump in?
And a lot of our clients are talking about ESG right now because they're trying to understand what metrics, how do we track them? If we're looking at bonds, how can I find any ESG related provisions, or in credit agreements, right? What's the purpose of the facility? If you want to drill in Alaska, probably not very good, right? So I think the ESG can potentially be super transformative because it touches everything in an institution, right? Not just the credit agreements, it's everything from government, systems, people, literally everything. But it's also fiendishly difficult to pin it down in a document. I think that's sort of until we have a more systematic or standardized way of reporting exactly what the ESG impact is in bonds or in credit agreements, it will be hard to track that. But I think it has the potential to be super transformative because it touches everything.
Yeah, I would say we've been including ESG or integrating ESG risk factors into our credit analysis for the last year and a half, and we're finding that most of our constituents are adopting policies and that it's pretty critical. I do also think that it's just kind of a self-interest. We've seen Stuart Rose, for example, became chairman of EG Group, and that's a long-standing leveraged loan borrower that was just been in private hands for some time, and there were concerns about the governance, and here you have Stuart Rose coming in to be the chairman of this company, and so it's an aspect of the market that's going to be here to stay. It's something that we integrate into our analysis, and obviously, the banks as regulated institutions have to be quite sensitive to the ESG risk factors that accompany their assets.
Thanks, Ed. I think this.
We're about done. We're about done, aren't we? We're running out of time.
We are indeed. Would you have some kind of final thoughts, Rick, on something that we haven't touched yet that you have on your mind with regards to the guidelines, or do you think?
Not in the guidelines, no. I think there's been very good discussion so far. We, as a trade association, would not know and shouldn't know details of what individual members are doing in terms of what they're working out with their individual supervisors. But we're very keen that the framework is set up in a proper and robust way. So we're continuing to take an active role in how this progresses.
Thanks, Rick. So this brings us to the end of the discussion. Thank you very much, everyone. And I believe that. Oh, sorry.
Yeah, Ben, I was going to say I have a couple of thank yous whenever you're done.
Well, I would like to thank you all as panelists. For the very fruitful discussion and the discussions that we had in preparation of this call, and thank you very much also to Gillian and Gary for organizing the panel. Rick, over to you.
Yes, and thanks very much, Ben, to you and to Simone and to Ed. I think it's a really good discussion. It's a really important issue across our different types of members of I've discussed. So we're going to continue to take an active interest in this. I also want to thank EIGEN for very much partnering with us on this webinar concept and the content and the topic. It's a very important one, and we're delighted that EIGEN was able to work with us on this. We'd like to thank everybody who participated today, you in the audience, take time to join in this discussion today. We're certainly hoping that we can do these types of events in physical form in the future when we're able to meet. Hopefully we'll be hearing news in the foreseeable future that let us be able to do that. And again, from all of us at AFME, we hope that you and everybody continue to stay safe, healthy, and interested in capital markets and prudential issues. So thanks very much.
Thank you, Rick, Ben.
Thank you.
All right.